Hey traders, Jason here from Levitt Brothers. So let's talk about the current state of the market. I'm going to go through the indexes, some breadth, give you some of my random thoughts on what's going on in the market, as I typically do every couple weeks. All right, let's get into it here. All right, first, this is the S&P 500 monthly chart. Looks pretty orderly. Nice rally off the 2020 low, COVID low. Large cup and handle pattern that extended over 2 years, and then a breakout in late 2023 and a pretty good rally since. A little bit of a dip right there. Overall, everything looks good. Okay, market's strong, it's healthy, it's moving up. The big picture looks good. There are no warnings here at all. Even if we got a dip back to the 50, that's not the 50, that's the 10-month moving average, which is, just over 5,600, which is like maybe, 230, 240 points below the current level. I'd still consider the market to be in good shape. Okay. We have a tendency to zoom in, look too closely at the charts, get a little, get overly excited when the market goes up or overly, upset when it goes down. But then you back up and you look at this chart and you realize the overall market is still doing just fine. Now, that doesn't mean you can just buy stocks and just hold them and just assume the trend is going to continue. You can't trade off this chart. But as a backdrop, the market is doing just fine overall. No reason for long-term holders to panic just because some short-term noise takes place. All right, let's go in with the weekly. Here's the weekly. You can see the large cup and handle pattern on the left side. We have, a 3-week pullback here, a little bit more than 3 weeks over here. You got a stiff down week there, 2 weeks there. And now this is the longest pullback per the number of weeks that we've had since we broke out of the cup and handle pattern. But the damage done is no worse than over here, and it's less than over here. So overall, not that bad. The market goes up, the market goes down, the market goes sideways. Long-term trend remains in place. Week to week, things could happen. But long-term, the market seems to be, still in good place. Now, if we dropped here to the 50 and then tried to rally up and, the 21 rolled over like this and, and we got rejected and went down, that's a different story. We'll play that as it comes. But as of now, I'm going to give the bulls the benefit of the doubt because the market's been strong for so long that they earned it. They deserve it. But again, as I said a minute ago, you can't just buy stocks and just assume that they'll do well simply because the market's doing well. You still got to manage positions. And of course, you always want to pay attention to where money is rotating because, within this time period, there have been some huge winners and some losers. Okay, there have been some groups that have broken out and gone 50 to 100%, and there have been some stocks that have gone absolutely nowhere. So even though the backdrop is really good, you got to pay attention to where money is rotating, and you want to be concentrated in those groups in the best performing stocks. All right, let's look at the daily before we move on to breadth. So here's the daily going back to last April. You can see pretty violent cup and handle pattern over here in August, September. Broke out September, moved up, tested the 50 there, moved up, and it's now trading in a falling wedge pattern. We had a gap down yesterday, but it recovered, and then we got a gap up, and right now it's pretty much holding its gains today. So this is kind of a volatile chart, like this dip in recovery, this dip in recovery. There was a gap down here, but then a gap up there. This is kind of a chaotic chart, but overall trend remains up. Market's doing just fine. And as always, you got to zoom in, see what's leading. Okay. Is it drones? Is it space? Is it AI? Is it robotics? Is it, nuclear power, like semiconductor, whatever. At any given time, there's going to be some groups that are doing extremely well and everything else is And if you're focused on the groups that are doing the best, that's where your big trades are going to come from. That's where your alpha comes from. That's where you can buy and make 20, 30% in a week or two versus some dead group that's just not going anywhere. All right, now let's look at some breadth. All right, here's the S&P 500 up top versus the 10, 20, and 50-day moving average of the NYSE AD line. Okay, typically you're going to get a lot of prints above zero when the market's doing well. When the market softens, you're going to get dips below. Okay, but temporary dips below are not an issue. The market moves up, then it digests gains. You're going to get a pullback from the AD line. It's not a big deal. It's when you get deeper prints and extended time below zero that problems happen. So if you go to the bottom with the S&P, with the 50-day moving average, you can see we've been, lowest level of the year we've been sitting at for the last couple of weeks. Same thing with the 20-day moving average. This is the lowest level of the year for the last couple of weeks. So it's a little bit of a warning that tells you that the softness that has taken place here has been worse than even the selling over here into the carry trade, the selling in September, even going back to April where we had a 3-week pullback. It's worse than there. Okay, maybe not worse as far as the price action, but as far as participation goes, it's been the worst. We've had the least number of stocks participate recently. But in the near term, you can say we have positive divergences forming. We got lower lows here. Okay, we got higher low from the 10-day moving average, higher low here, higher low here. So breadth has not been good. Okay, participation has not been good. Decliners have been outnumbering advancers, but it's not been good, but it's been less bad. So maybe we're starting to turn a corner here. But I think the onus is on the bulls to prove it. Okay, right now the ball's in the bears' court. They have a little bit of the advantage, and if the market wants to bounce here, we need to get prints back above zero. And they need to stay there. Okay, I mean it's simple as that. We need the bulls have something to prove here. They can't relax. They can't be lazy. They got to push it a little bit and improve these indicators. Breadth needs to improve. All right. So here's the cumulative AD line versus the NYSE, or versus the S&P 500. With the 21-day moving average, and you can see what happened here is that we broke a support level here, and it's been consolidating here, basically underneath its declining 21 moving average. So, I mean, this is from a chart pattern standpoint, this is classic bearish stuff. To break down from a top, consolidate sideways, get capped off by a moving average. Like, this is like the bears are in control until proven otherwise. Okay, if the AD line could break out and then come down and successfully test and go, great. Okay, but until that happens, we got to be careful on the long side. Okay, because we got to keep in mind that over the last couple weeks, over the last month, the decliners have outnumbered advancers, and that could persist in the near term, but it can't persist, overall. If I go back to like last April, we got a deep drop below the 21, but then we got a quick recovery, a consolidation here at the 21, and we took off. Same, we got a deep print down below the 21 here, but we haven't recovered yet. Okay, so I don't think we can expect this to play out over here until we get some improvement from the AD lines. Okay, so right now bears are slightly in control here. All right, here is the 1 month high low. Okay, number of stocks making a 1 month high versus number of stocks making a 1 month low. SP 500 up top, and then the indicators down below. It's typical in an uptrend to just get prints above and below zero with a lot more prints above. That's pretty normal. The warnings come when you get a deep print down or an extended period of time where prints stay below zero. Okay, so this is normal. This is normal for an uptrend. This is normal for an uptrend. You get a lot of prints above zero. What I'm concerned with right now is that we broke down below zero last month, and we haven't really been able to recover, and this is a little bit reminiscent of what happened back in August, September, early October of 2023 when we got that 3-month pullback. Okay, so what I want right now, or not what I want, but what I'm looking for is the bulls need this to get above zero, maybe back test and hold. But if it stays below zero, where the market's going to go down. As simple as that. Like just as this stayed below zero for 3 months, and we got a 3-month correction, if we can't get above zero over here and hold, then we're going to get an extended pullback here. It's as simple as that. Now moving on, here is essentially the same thing, but it's the 3-month high low, and I'm not going to dwell on this too long. My analysis is the same. when you have an extended time below zero like this and an inability to recover above zero, you get a drawdown. Okay, and it's what's happening right now. We have a drop below zero last month, and so far no ability to recover. And unless we recover, then this is going to extend down. Doesn't mean that like the long term is doomed. It doesn't mean we can't pull back 5% to a key long-term moving average and then rally and go to a new high in March or something like that. Like that's possible. Okay, but I'm saying if I'm looking out over the next couple weeks, market's not going to, actually anything can happen like week to week, but if I'm looking out over a month, the market's not going to move up in a sustained way unless we get this above zero. Okay, next one, this is Russell 3000 stocks above their 20-day moving average. This tends to, there's a distinct way that this moves when the market is either in a correction or an uptrend. Generally speaking, you're going to get, when the market is acting fairly well, you're going to get a lot of prints between like 40 and 80%. Okay, so 50% is like right here. It's okay if you have these dips below 50%, but generally speaking, you're going to get these oscillations between 40 and 80%. You do get dips below. Okay, the market rests, it pulls back, it drops a couple percent. You do have some stiff selling periods, even within an uptrend, where the indicator will drop to a low level. But typically, when the market is healthy, it will recover. When the market is not healthy, it either doesn't recover or it doesn't recover to a high level. So if I compare it to that 3-month correction we had back in 2023, you can see that we had deeper prints, below 20%, and then each time the market tried to bounce, like bounce there, only got up to 60%, lost it, tried to bounce there, only got up to 60%, lost it, and then when it bounced there, it finally got to a higher level, it moved up to a higher level, came down and tested, and then went from there. Okay, so if I look at what we got right now, we have, we don't even have prints up at 60%. We've had for a couple weeks, we have prints below 40%. Okay, so if the bulls want to take control, if they think the market wants to go up, like this has got to improve. Okay, if it sticks down here, there's just simply no way the market's going to bounce when you have only 25% of stocks above their 20-day moving average. Okay, that could last for a few days or a week because of the math with some of the Nvidia and Apple, and if those stocks are doing well, then it lasts for a little bit, but it's just not going to last very long unless we get better prints here. And then here's the Russell 3000 stocks above the 50-day moving average. It's the same thing. I don't need to rehash this stuff. You tend to get a lot of prints between 40 and 60% when the market is in correction mode. You can see obviously there's a difference between these two boxes, and right now we're down here. So unless we get better participation, unless we have more stocks above their 50-day moving average, the market is not going to rally. Okay, so like right now the market's up today as I record this. It could follow through for a few days, but unless we get improvement here, the strength that is playing out today is not going to last. Okay, so that's all I got right now. The indexes overall are in good shape, but we don't trade off the weekly and monthly charts because there's too much noise in the short term. You can't just buy something and hold it and assume that, well, hey, the market's in good shape overall, so I'm just going to hold. Overall the market's in good shape, but in the near term, there's definitely a lot of weakness. The bears are in control. The AD line is declining and below key moving average. Stocks, the 1 month and 3 month high low are sitting at levels that are characteristic of a mini downtrend, not an uptrend. Stocks above their 20 and 50-day moving average are in the same position. Okay, so right now bears are in control. If you're a long only trader, you got to be very careful. Trade only the best stocks. The market is not in a euphoric state right now. Stocks aren't breaking out at 15 and running up to like 22 like what happened this fall. Okay, that market is over. You have to adjust your expectations. You have to adjust how you manage positions. Big uptrends with euphoric price action build bad habits because most stocks go up, and if they go down, they don't go down that much. So you got to be much more disciplined, much more diligent. Don't be lazy. Don't be complacent. Be content with 5 and 10% wins. Don't, the days of 50 and 100% wins, which is what we got for a lot of 2024, are over right now. Okay, Be disciplined. Don't get lazy managing positions. The goal here is to make a little bit of money here and there, not to shoot for the moon. All right, we'll see you next time.